Hello and welcome to lecture number 4. We'll be discussing the functions of the Fed. This comes from chapter 4 of your book. In the late 1800s, early 1900s, the United States had experienced several banking panics. And so in 1913, in an effort to enhance the safety of the US banking system, the government enacted the Federal Reserve Act, which created the Federal Reserve System, which is what we are talking about when we say the Fed. It's the Federal Reserve. So our objectives in this chapter are to describe the organizational structure of the Fed, describe how the Fed influences monetary policy, explain how the Fed revised its lending role in response to the credit crisis. We're talking about the credit crisis of 2007 through 2009. And we'll explain how monetary policy is used in other countries. So as an overview, the central bank of the United States is the Fed. The Fed conducts national monetary policy in an attempt to achieve full employment and price stability. So we're looking at low or zero inflation in the United States. So that's the mandate of the Fed. We're trying to, the Fed's trying to achieve full employment and price stability. So we're looking to avoid inflation and have as many people as are willing and able to work working. Since the Fed's monetary policy affects interest rates, it has a strong influence on the cost of borrowing by households. Also, monetary policy affects the cost of borrowing by businesses and thereby influences how much money businesses are willing to borrow to support or expand their operations. So the Federal Reserve has what we call district banks. And if you look in your book, Exhibit 4.1, we'll show you that, and we'll take a look here in just a second. There are 12 Federal Reserve district banks. The New York Fed is considered the most important. Commercial banks purchase stock in their Federal Reserve District Bank to become members. So commercial banks become member banks when they purchase stock in the Federal Reserve District Bank. The stock pays a maximum dividend of 6% annually. So one benefit to commercial banks is this dividend, but certainly there are other benefits which we'll discuss. Each Fed district bank has 9 directors. So there are 12 district banks, and each of those 12 banks has 9 directors. So they facilitate operations within the banking system by clearing checks, replacing old currency, and providing loans through the discount window to depository institutions in need of funds. And we'll talk a little bit more about that later on in this lecture. So here are the locations of the different Federal Reserve District banks. So for Utah, which is where our university is sitting, we're in this district, District 12, and that may sound like we're in Hunger Games, but no, we're in the Federal Reserve District Bank of District 12. I know that was a terrible joke. And so you can see the different districts, and New York is, as mentioned, the most important one. So these are the boundaries. The red lines are the boundaries of each district. And then we've got territories within those districts. So these blue lines represent the territory lines. You can see Board of Governors of the Federal Reserve. It's right here in Washington. And then Federal Reserve Bank cities. So San Francisco, Dallas, and so forth. So member banks are commercial banks, and commercial banks can elect to become member banks if they meet specific requirements of the Board of Governors. All banks are required to be members of the Fed, all national banks, sorry. So a local bank is not required to be a member of the Fed, but a national bank, if they want to be a US national bank, they have to be a member of the Fed. So let's talk a little bit about the Board of Governors. The Federal Reserve Board is made up of 7 members. Each member is appointed by the President of the US and serves a non-renewable 14-year term. One of the 7 board members is selected by the President to be the Federal Reserve Chairman for a 4-year renewable term. One of the 7 board members is designated by the President to be the Vice Chairman for supervision, according to the Financial Reform Act of 2010. So this is a new position on that 7-member board, the Vice Chairman for supervision. So the Fed has what they call the Federal Open Market Committee, FOMC. It's made up of the 7 members of the Board of Governors, plus the presidents of 5 Fed district banks, the New York District Bank plus 4 of the other 11 Fed district banks, as determined on a rotating basis. So the New York Fed is always on that committee, and then there are 4 others which rotates amongst the other 11 Fed district banks. There are also advisory committees. There's the Federal Advisory Council, which consists of 1 member from each Federal Reserve District who represents the banking industry, meets with the Board of Governors in Washington, D.C. at least 4 times a year and makes recommendations about economic and banking issues. There's the Community Depository Institution Advisory Council, is formerly called Thrift Institutions Advisory Council. It consists of 12 members who represent savings banks, S&Ls, the savings and loans, and credit unions. They meet with the Board of Governors twice a year. Then there is the Community Advisory Council, which consists of 15 members who offer diverse views on economic circumstances and the financial services needs of consumers and communities, with particular emphasis on low and moderate income population. So they're looking at those who might be a little bit more underserved in the community. They meet with the Board of Governors twice a year as well. So how are the different components of the Federal Reserve integrated? Exhibit 4.2 in your book will show you how these are integrated, and we'll look at it here in just a second. It shows the relationship among the various components of the Federal Reserve System. Advisory committees advise the board. So they give advice to the board, and the board is the group that makes a decision. The board oversees operation of the district banks. So here we've got advisory committees. You can see here in Exhibit 4.2, they give advice to the Board of Governors. The Board of Governors regulate member banks and bank holding companies and set reserve requirements, which we'll talk about here in just a second. They perform a supervisory duty over the district banks. Remember, there are 12 district banks, and these district banks clear checks, they replace old currency, and provide loans to depository institutions. And between these two, we have made up the Federal Open Market Committee, FOMC, which conducts open market operations, which we'll discuss here in just a little bit. So we have the Board of Governors plus some of the members of the district banks. Now let's discuss the Consumer Financial Protection Bureau. And this was established as a result of the Financial Reform Act of 2010, which came as a result of the credit crisis. They're responsible for regulating financial products and services, including online banking, certificates of deposits, CDs, and mortgages. Now, you'll remember a huge impetus for credit crisis had to do with bad mortgages. Open market operations. So the FOMC meets 8 times a year and sets targets for the money supply growth level and the interest rate level and implements monetary policy. So They make policy with an attempt to affect money supply and interest rate levels, and they also implement new monetary policy. So there's a pre-meeting economic report that comes out. It's called the Beige Book. It's a consolidated report of regional economic conditions in each district. Then there are economic presentations. These presentations include data and trends for wages, consumer prices, unemployment, GDP, business inventories, foreign exchange rates, interest rates, and financial market conditions. So they talk a lot about the economic condition of the country and also the world, how it affects the US. Then they make some decisions. Each member can offer recommendations regarding the federal funds rate target. We'll talk about that here in just a second. Then they have a statement after they've made some decisions. Generally, the chairman of the Fed will make a statement that summarizes their conclusions. So, and then they publish the minutes of their meeting. And there's a lot of information that could be gleaned from these minutes. It's provided to the public and are also accessible on the Federal Reserve website. Okay, so here is a chart showing the federal funds rate, the Fed funds rate over time. It's going back to 1990. So you can see the Fed funds rate was over 8% back in 1990. We saw it drop significantly. It's come back up and then come back down and back up and back down. And then this is where we've rested close to zero. Even today in 2020 with the COVID-19 crisis, we are at historic lows of the Fed funds rate. So you can see here, these shaded areas indicate US recessions. And so you can see the Fed is making, taking steps to lower this rate during recessionary periods. We saw it in early 1990s. We saw it after the dot-com boom and bust, and we saw it through the credit crisis as well. So how does the Fed control the money supply? The role of the Fed's trading desk. So the Fed has a trading desk which helps to control the money supply. So if a change in monetary policy is appropriate, the FOMC decision is forwarded to the trading desk. This is the open market desk at the New York Fed through a policy directive. So the Fed can purchase securities. So that's one of the things that the trading desk will do. So to lower the federal funds rate, traders purchase treasury securities from securities dealers, and the dealer's bank account balances increase, causing an increase in the supply of funds. So the Fed is taking treasury securities off the market and replacing them with cash sitting in the bank accounts of the dealers' banks. And so they're putting money out into the money supply by buying back their own securities. On the flip side, the Fed can sell securities. So to increase the federal funds rate, let me go back up. Again, to lower the Fed funds rate, they'll purchase treasury securities. To increase the federal funds rate, traders sell government securities to government securities dealers. As the dealers pay for the securities, their bank balances decrease, leading to a decrease in the supply of funds. So then the Fed, by selling the securities, is taking money out of the market, so reducing the money supply. Fed trading of repurchase agreements. So the Fed can also trade repurchase agreements, purchases treasury securities from government securities dealers with an agreement to sell back the securities at a specific date in the future. So it's a repurchase agreement. So there's a specific time frame of these. So they purchase the securities from the dealers with an agreement to sell it back at a specific date. So when the Fed conducts open market operations to adjust the money supply, it must also consider the measure of money on which it will focus. So what measure of money is it going to look at? The optimal form of money should be, one, be controllable by the Fed, so they can control it, and two, have a predictable impact on economic variables when adjusted by the Fed. So M1 includes currency held by the public and checking deposits, such as demand deposits, negotiable order of withdrawal, that's now accounts, and automatic transfer balances at depository institutions. The M1 measure does not include all funds that can be used for transaction purposes. So we can look at M2, which includes everything in M1, so all of these, plus savings accounts and small time deposits, money market deposit accounts, and some other items. And then M3 includes everything in M2, which of course includes everything in M1, in addition to large time deposits and other items. So here are the money supply measures. This chart is Exhibit 4.4 in your book. So M1 equals currency plus checking deposits. M2 equals M1 plus savings deposits, money market deposit accounts, overnight repurchase agreements, euro dollars, and small time deposits. M3 equals M2 plus institutional money market funds, large time deposits, and repurchase agreements and euro dollars lasting more than 1 day. So these are the different money supply measures. Going onward, there are some technical factors that need to be considered. Technical factors include currency in circulation and Federal Reserve float. The manager of the trading desk incorporates the expected impact of technical factors on funds into the instructions to traders. Then we've got dynamic versus defensive open market operations. Dynamic operations are implemented to increase or decrease the level of funds. Defensive operations offset the impact of other conditions that affect the level of funds. So how does the Fed operations affect the interest rates? So even though most interest rates are market determined, we learned that in Finance 3250, the yield is determined by the market, the Fed can have a strong influence on these rates by controlling the supply of loanable funds. Open market operations in response to the economy. In 2001 to 2003, the Fed frequently used open market operations to reduce interest rates during this period of weak economic conditions. You'll remember we had the dot-com boom at the end of 2000 or 1990s. There was a lot of irrational exuberance, and then everybody realized that companies that were consistently making losses and never showing profits maybe were not worth as much as the market had originally thought. So we saw this dot-com bubble burst and a crash, and so the Fed used open market operations to reduce interest rates during that period. From 2004 to 2007, the Fed's concern shifted from a weak economy to high inflation as the economy improved. So they started to raise or attempt to raise interest rates. In 2008, however, the Fed used open market operations to reduce interest rates in an attempt to stimulate the economy when economic conditions weakened due to the credit crisis. Economic conditions remained weak through 2012, at which point we've seen a steady growth and improvement in the economy up until this COVID-19 crisis. We are now seeing very similar approaches, their open market operations and response to the current crisis of COVID-19 have been similar to previous crises, and with some additional things that they've done. Another thing that the Fed can do is adjust the reserve requirement ratio. So what is the reserve requirement? The reserve requirement is the proportion of bank deposit accounts that must be held as required reserves or funds held in reserve. This has historically been set between 8 and 12% of transaction accounts. So when you deposit money in a bank, the bank doesn't just leave it there. They loan it out. But they have to keep a certain amount in reserve, and that amount has ranged between 8 and 12% historically. So by reducing the reserve requirement, the board can increase the proportion of a bank's deposit that can be lent out. So if it was currently sitting at 12 and then they decided to adjust the reserve requirement down to 8%, that 4%, now the bank doesn't have to hold it in reserve, they can now lend it out. And the lower the reserve requirement, the greater the lending capacity of a depository institution. So what is the impact of reserve requirements on money growth? Leakages occur when households hold cash or banks hold excess reserves. In these cases, the money does not multiply as expected. And so this multiplication happens when banks lend money out. That money might be deposited in the bank again, then they can lend it out again, and that multiplies the money. But when households just hold cash, you put it on your mattress, or banks hold excess reserves, it removes the opportunity to have the money multiply. So here's an illustration of what we call the multiplier effect. So let's start here, and we're going to end up down here. So we've got an increase in deposits at a bank. So somebody walks in with $100 million cash, deposits in the bank. The required reserves held on new deposits, we're assuming is 10 million. So that would be 10%. So required reserves, 10%. Funds received from new deposits that can be lent out, 90 million. So they're going to lend out the 90 million. The 90 million gets put back into banks, and now it's sitting in the bank again. So it started in the bank, was lent out, now it's deposited back in the bank, a new reserve requirement on this 90 million deposited, which allows us to lend out 81 million this time. This 81 million is now deposited in the bank again, which means that it could be lent out with the exception of the reserve requirement of 10%, which is 8.1 million. Then they can lend out 72.9 million, and it goes on and on and on. So this is what we call the multiplier effect. These funds are deposited and lent out, deposited and lent out over and over and over again. The Fed also adjusts what is called the Fed's loan rate. Before 2003, the Fed set its loan rate, then called the discount rate, at low levels when it wanted to encourage banks to borrow. So these are member banks can borrow from the Fed. Since this activity increased the amount of funds injected into the financial system. So when the Fed wants banks to borrow more, they'll lower the Fed loan rate. And then banks will borrow that money, and that money gets injected into the financial system. If they want to start taking money out of the financial system using the Fed loan rate, they'll just increase the rate, which will make it less palatable to borrow. And since 2003, however, the Fed's rate on short-term loans to depository institutions has been called the primary credit lending rate. Primary credit lending rate is what we call it now, which is set slightly above the federal funds rate. Primary credit rate is shown in Exhibit 4.6 of your book, which we'll take a look at right now. So this was the Fed loans rate, or the discount rate, as it's been called historically. Now it's called the primary credit rate over And this is showing it over time. So we can see starting in 2003, we're right at 2%. Then we see it step up over time. Each of these steps is the Fed making a decision to increase that rate. It remained just over 6, but you can see during the credit crisis, it decreased rapidly, and it's remained low and is even lower again today because of COVID-19. So during the credit crisis, 2007 through 2009, the Fed did a lot to intervene, and we're going to run through some of those interventions. So the Fed loans to facilitate rescue of Bear Stearns. Bear Stearns was a financial institution that got in trouble, and so there were federal loans or Federal Reserve loans, Fed loans, to facilitate the rescue of Bear Stearns. So during the crisis, the Fed provided funding through the discount window. Bear Stearns, a non-depository institution, was able to borrow at the discount window through a loan to JP Morgan. So JP Morgan had to step in because they're a member bank and facilitate this loan to Bear Stearns. Fed purchases of mortgage-backed securities. So mortgage-backed securities are securities where maybe an investment bank has purchased up a bunch of loans and bundled them up into a pool and then sold securities which were backed by that pool of mortgages. Well, what happens when the mortgages in that pool turn out to be all bad mortgages? What happens to the value of those securities? So the Fed propped up the market by purchasing some of these mortgage-backed securities. In 2008, the Fed created various facilities that provided loans to financial institutions that purchased particular types of debt securities. So in 2010, the Fed closed most of these facilities. I know a gentleman who's actually in New York, and he made a lot of money standing in between the Fed and purchasing these types of securities, and was able to unwind them in such a way that he made a lot of money. The Fed purchased bonds backed by loans. So Term Asset-Backed Security Loan Facility, TALF, created to provide financing to financial institutions purchasing high-quality bonds backed by consumer loans, credit cards, or automobile loans. So these were high-quality bonds, but they were backed by these consumer loans, credit card loans, and automobile loans. When we have had the credit crisis, people started losing their jobs, these loans were not paid. And so it affected these bonds significantly. So the Fed provided facilities for the purchase of bonds. Fed also purchased commercial paper. So commercial paper is the short-term debt instruments that corporations use to borrow money on a short-term basis. So they'll issue commercial paper, borrow money, and then pay it back. So normally the Fed did not purchase commercial paper, but in 2008 to 2009, they implemented this to offset the reduction in market demand due to investors' fears of defaults. So investors started to fear that there would be defaults. The companies that issued the paper wouldn't be able to pay it back. So, so they started purchasing the commercial paper to help prop up the market of commercial paper. Fed also purchased long-term treasury securities. They purchased large amounts in 2010 to reduce long-term treasury bond yields. So, so we saw them go out and buy a lot of their own treasuries to pump liquidity into the system and to reduce bond yields. So what were the perceptions of the Fed's intervention during the crisis? Most agree that the Fed took a lot of initiative. Many disagree on what steps the Fed should have taken. Hindsight's 2020, a lot of people have disagreed. We have a similar situation now with COVID-19, wherein the Fed is taking actions. Some people are complaining that they're repeating some of their same mistakes that they made during the credit crisis. Although this crisis is slightly different in nature, a lot of the things that they're doing are very similar to what they did during that crisis. I highly recommend you look at the news and see what you can find in regards to the Fed's response to these crises, as well as what their current open market operations might be. Now a word on global monetary policy. So each country has its own central bank, like our Federal Reserve. There's the European Central Bank, the Bank of England. They control the money supply and monetary policy for the Bank of England for England, European Central Bank for the European bloc or European Union. Central banks of other industrialized countries use open market operations and reserve requirement adjustments as monetary policy tools, just as the Federal Reserve does. The Fed has to consider economic conditions in other countries when assessing the US economy. Let's look at a single Eurozone monetary policy. This has been an interesting experiment to watch. So we have this European Central Bank. It's based in Frankfurt. It's responsible for setting monetary policy for all European countries that use the euro. So while up until this year, the UK was a member of the European Union, they did not use the euro. They used the Bank of England. And so because they didn't adopt the euro, they weren't beholden to the European Central Bank. The European Central Bank's monetary goals are price and currency stability, very similar to the Fed's mandate. So what is the impact of the euro on monetary policy? Any changes in the money supply affect all of the European countries that use the euro, and not all of the countries are on the same footing. So this is a very difficult process for the European Central Bank to take, because you have strong economies or stronger economies such as Germany's, or weaker economies such as Greece, and how do they deal with each member country. They prevent participating countries from solving local economic problems using their own unique economic policies. So when Greece was going through their crisis and are still going through their crisis, they had to go to the euro or the European Central Bank to deal with some of those issues. So let's look at the global central bank coordination. In some cases, central banks of various countries coordinate their efforts for a common cause. So they're working towards something that will be of benefit to all of the nations that coordinate. Global monetary policy during the credit crisis included, from August to October of 2008, stock market prices in the United States, Canada, China, France, Germany, Italy, Japan, Mexico, Russia, Spain, and many other countries declined by more than 25%. I was in the investment industry when that happened, and it was pretty harrowing. They targeted interest rate levels, and these targets by various central banks have changed over time, but they tend to move in the same direction. So that concludes lecture number 4 on the functions of the Fed. I hope that was useful. If you have any questions, feel free to reach out to me. I can be contacted during my office hours, or you can send me an email and we can schedule a time if my office hours don't work for you. Thank you very much.